You got to stop tipping the government. It's your duty and responsibility to save on taxes legally and ethically. You look at every expense in your life and you ask one simple question: does this relate to my business? If the answer is yes, guess what? That expense becomes a deduction. This is where I crushed it for Pete. So I'm giving you Pete's strategies right here that got him. I think he's 100% of the way economically independent now, or very close. But the problem is he would have been, but his lifestyle, a luxury once enjoyed becomes a necessity. He was in Park City this week. He was in Aruba recently. So we had him 81% of the way there. I think we got to 100. Now he's back down to like 81% because life is good, right? And his business is doing well. And that's totally cool because I want people to enjoy life. But this was the first thing that we did. Any of you ever host clients, employees, vendors at your own home? Okay, well, there was a senator that had a home in Augusta, Georgia, and there's 14 days of the year where Augusta, Georgia becomes extraordinarily valuable. You may have heard of it. The Masters, yes. So he wanted to be able to rent his place out during that time for like 5 times what it would normally get rented out for, but he didn't want to pay tax, so now we have the Augusta rule. You can rent your home out to your business 14 days a year, write that off for the business, and you don't have to pay tax personally. The days I like to rent out are in Utah. There's the outdoor recreation show. Yep, you can rent it for 3 times as much because you just pull up the Airbnbs, or you go to a conference center, ask how much it is. Everything's more expensive and it's sold out. Or we had some clients in Cleveland during the Republican National Convention, so they charged 3 times more for the time they hosted a dinner. As a matter of fact, Aaron in the back of the room with the beard and the very strong lad that obviously does too much CrossFit, he came about working with us because he came to one of those dinners where I had hosted some clients and some of our team. But at the same day, we got this huge piece of furniture dropped off, and the movers were like, we can't get that up the stairs, thank you. So it was just in the middle of our house for this function. I said, dude, need some functional fitness, will you come move this? I'll let you stay for dinner. He's like, I love your team, I love your clients, I'd love to work with you. So hell, you get all these extra bonus features while you're writing stuff off, right? So the Augusta rule is a big deal. That was about $75,000 of savings for Pete. Every year, because he's hosting stuff at the Broadmoor, then he'll just bring his inner circle over to his house, have a little dinner, and all of a sudden you get to write that off. The other thing is, if you have kids that are 18 and under, you can pay them $6,300. Now you have to have a reason to pay them, not that they mowed the lawn. That doesn't really do a whole lot. But there's a $2,500 modeling fee if they show up in your office or on your website. That's union standard. You know, I'm paying my kids $1,000 a month now because I'm writing a children's book, so the 9-year-old's helping me with that. He's my research. The 12-year-old started an e-commerce business because we have so many people in e-commerce that I'm like, I need to know everything about it and see what it's like and go through it. So I'm going through that with him to help him start his first business. So I'm paying them, and I get to write that off. No taxes at $6,300. Their tax rate above that, which is 10%, that's a pretty cool way to turn an expense and turn it into a deduction. So you just have to document. That's the key with this. Documentation. I'm not an overly analytical person. I document it on my American Express bill. My CFO prints stuff out, has folders. I mean, it's an amazing, but I've been audited twice in my life, 0 issue, and I'm super aggressive on write-offs. Like, this is my uniform. Because when I'm not on stage, I've adopted the yoga lifestyle. I don't do yoga, but I wear yoga clothes. So I don't write those off, but then I write this off, right? You know, I could tell there's some other folks that do the same thing. You know, my wife doesn't do yoga, but she got tons of Lululemon all over the house, so it's cool. It's just comfortable. She sold me on sweats. Now I'm the dude wearing sweats, you know? So, useless facts for you guys in the middle of the content, but I actually write this off as uniform. So I have a TV studio. We have a multi-platinum artist that he's like, oh, I can't write off my clothes. I'm like, do you do your own videos? He's like, yeah. I'm like, cool, we're just gonna set up a production company. We're gonna buy the clothes for the production company. As a matter of fact, we're buying watches. We're buying anything that shows up in the video through that. And guess what? Now an expense turns into a tax deduction. Home office, you can write off half your utilities. I just bought a nice espresso machine. I made sure it went into the corner by the office, and that's where I make my espressos. And now all of a sudden I get to write that off. Documentation and story, right? Now, the third thing, we can go through tons of that, but you've got the idea. You want to do an annual meeting in cool locations, that's an expense turned into a deduction as well. You just got to take notes. I just use Evernote. It takes me about 2 seconds, and at dinner, I go through the notes, and then I just send it off to my attorney. Now it's compliant. Now I can write that off. So how can you maximize your deductions? How can you make sure that each dollar can be more productive? Because in today's tax environment, the more productive the dollar, the better you get with tax deductions. Here's an example. I just heard Tom Wilwright speak recently. He talked about, hey, guess what? If you have a home office, you actually can write off more of your vehicle. Why? Because you're at home and going from your home office to another office. Now that's giving even more justification for that vehicle. You're maximizing deductions. So in what other ways can you maximize your deductions? Whether that's paying your kids, and that's tax deductible and they don't have to claim income, whether that's renting out your home to your business for 14 days a year, or whether it's making sure that you're documenting every dollar you spend that goes into being more productive for your business.
The second thing to look at with taxes is maximizing your deductions by doing two things: documenting everywhere you spend and asking, does it relate to the business? If it does, talk to the accountant and see if it could be a write-off.
Yeah.
Most of the time it can, not everything.
So for deductions, I just have two main rules. Number one, you ask anytime you make a purchase, does this relate to my business, or how does this relate to my business? And number two, you document it. Now you might take things like my Can-Am that I've now put down on my list. I'm not actually filing taxes and writing that off. It's on my list because I'm going to ask on my quarterly meeting, can I write this off? Some people go like, I don't think this is something I can write off, so they don't record it, and then it never has a chance. I'm going to have it have a chance until they tell me no, right? So number one, document it, right? Number one, just make sure to ask how it relates to the business, and number two, document it, and then just find some of the cool nuances in the tax deduction world. Anyone in here know the Augusta rule? Did I talk about it last time? So the Augusta rule is awesome because you can rent out your home 14 days a year to your business. You can write that off. Just a funny story on this. So we were going to do the Augusta rule. David was at one of our events. And so I had hired some cooks. We were going to have a dinner at my house. I was renting out the house to the business. That's a tax deduction for the business. It's not taxable to me if it's 14 days or less. Well, at the same time, my wife had ordered something from this restoration hardware store that apparently white glove service means they drop the armoire right in the hallway when you open the door. So David and 5 other people, including Aaron that's with me, we had to get that thing up the stairs. I mean, like, we're risking everybody's health getting this heavy thing up there, but we Augusta ruled that, so we got to write it off, right? Posted that, but I don't have to claim that as personal income. Or I pay my kids $12,000 a year each, because you can pay them $12,000 a year, as long as you're actually having them do work worth $12,000 a year, and that's tax-free if they're 18 and under to them, but it's tax deductible to you. So those are some examples of tax deductions. I mean, there's hundreds of them out there, and there's a lot of ones that people miss simply because they just didn't document it and they didn't have these conversations with their tax team. Reclassifying income means we had this guy, Mike, who joined our program back in 2008. He lived in some place in Illinois I'd never heard of. There's no airport there. And he said he loved the program, but he wasn't going to meet with our accountants. And I was like, why not? He's like, well, because I have the best accountant in the world. I'm like, I'm certain that you don't have the best in the world. So certain that I'm a Bears fan, he's a Bears fan. I said that if we don't save you tax, I'll take you to a Bears game. If we do, you take me. And I should have been more specific because he took me to a Jacksonville Bears game, which is not top raft. I couldn't even see the field, you know? I was watching from my phone. And by the way, this is what we did. He was a sole proprietor. If you're a sole proprietor and you're a corporation and you have a company, 400% higher chance of audit by being a sole proprietor. A 100% chance of a higher tax rate, because if you're incorporated and you overpay taxes, you have 3 years you can go back and amend your returns. So every 3 years have a different set of eyes on your taxes. In 2006, it was a crazy year because we had a company plane and 2 of my partners died in a plane crash. And I wasn't really myself during that time, and I didn't meet with my team, and I overpaid taxes by $54,000. But fortunately, I have the mechanism that every 3 years we look at it. So in 2008, I got the IRS to write me a check for a change, right? So you can go back and amend those returns. We've had people get $457,000 back, and we had one person get $951 back. I'm like, it's probably not worth it. He goes, if it costs me $950 to do it, I'm doing it. And so we gave him a nice discount, and he got his money back, right? So reclassification of income is setting up the right corporation. If you're in a partnership, an LLC is brilliant. If you're not, it might not be the most effective thing, because when you tax as a partnership, that's useful for you. When you don't, not as useful. If you're the only person in the business, an S Corp's great, because you can differentiate your income by taking salary of what you would hire someone else to do your job and take everything else in distributions when you work on your business. And by the way, distributions, avoid the 15.3% self-employment tax. Even when that's capped out, you still save 3.2% on Medicare and Medicaid. Even when you get above $250,000, you save another 3.7% on the success tax that's added in there. So this is money in your pocket simply by taking your income differently. Anyone own a commercial building in the room? If you own a commercial building, you should be the meanest landlord in the world to yourself and charge the highest possible amount that you could justify, because that comes in as a more passive-based income, which is taxed a lot less than income that's active, right? Or there's tons of ways you can move ordinary income into capital gains income, and I shared that with another thing. Now, maybe in your businesses, you even create like businesses that branch off from your business, or like we have a lot of people that are in the health space and they do supplements. We have them set up their supplement business when it's starting in a C corporation, because your first $50,000 in a C corporation is taxed lower than individually, an LLC, or an S corp. It's taxed higher after that, but it's less at the $50,000 and below, so we can set that up as an incubator company and then move it back into the major organization when it gets above $50,000. And our average savings on tax for every $250,000 someone makes is $11,430. By the way, that's bottom line spendable cash. That doesn't require revenue that you pay employees and all that kind of stuff.
Then the third area is reclassification. So I've mentioned it a little bit, but there's 4 ways to do that. Number 1 is make active income more passive for tax purposes, because that can save you up to 15.3%.
And how does someone go about doing that?
They choose the right type of corporation. They pay themselves a little bit differently. They have, if someone owned a commercial property their business was in, they charge the top dollar rent for that. It comes in with less self-employment tax. Those are a couple examples. The second is turn ordinary income into capital gains. So if you do business internationally, you can set up an international sales corporation and take all that money through your international sales corporation, comes in as capital gains, which could be 0, 15, or 20% instead of as high as 37.5%.
Okay.
The second big mistake people make is deferring tax. Deferring tax is a major mistake. If we go back to 1944 all the way to 1981, the tax bracket was above 50% during that entire time. So what happens if you take a 37.5% tax rate and you defer into a rate that's like 60 or 70%, or at the top it was at 94%? Well, what happens in that situation is you never want to take the money out, because if you hate paying tax today, I'm here to tell you, you're going to hate paying it more in the future. See, because what I found is with age comes bitterness sometimes, right? Like my grandma. When I'm like, Grandma, you're 70 and a half. You have to take this money out of your 401k. Otherwise, that required minimum distribution will give you tax and penalty. And it was the first time I heard her say the F word, to be honest. But not the last. Once that dam broke, But see, the committee kind of goes away. So like if you hate paying tax, deferring it isn't necessarily saving it. It's delaying it. And if you don't have a clear exit strategy, or you don't have offsets, then what happens is it might as well be a 100% tax rate, because if you don't want to get to it and pay the tax on it, what good was it anyway? It's never being utilized. It's one of the worst things in a retirement plan to pass on to the next generation. You can do a stretch IRA, which means no one ever gets the money. I mean, it's like, yeah, you can keep deferring and delaying, but eventually there's going to be that day of reckoning, and when it is, well, you hope it doesn't all get taxed in 1 year, because it might be a larger sum of money, or what it does to the other assets. So if you do have those plans, there's things that you can do, like a rescue strategy. Like if you have a retirement plan, everyone, no matter how much money you make, how much wealth you have, you do have the right to convert that to a Roth. When you convert it to a Roth, if you can get a valuation on the assets to be less than what it's actually worth, like structured settlements do, then you're going to pay less tax, and at least you're now in a tax-free environment. So if taxes go up, you're not subject to that higher tax. So that would be one example of something you can do. What I did is, when I realized these things weren't great, here's how I recognized they weren't amazing. If you were to start a financial institution today, what do you want from people? You want their money, right? How often? Yeah, all the time. How long do you want to hold on to it for? Forever. And then how much do you want to give them back when they want to withdraw? Hence the retirement plan. It follows those 4 rules. Like, how awesome for a financial institution, because not only do they get to take fees on your money, they take fees on the government's money. There's restrictions to when you get to that money. There's automatic deposits now, and if you're an employer, typically your employees are automatically opted in with the new rules unless you choose differently, and if you don't, that's usually the default. So awesome, they get to put money in that even if they have double-digit interest rates with their other, credit cards and stuff. So I don't think deferral and delaying is the best thing. It typically doesn't work in most areas of life. The only time I found deferral and delaying to be really good is you should always file an extension on your taxes. Because if you file an extension, you've just bought more time for your amendments.
You want to build the right team, and there's up to 4 people on the team. One is just someone to get you your data on time. That might be a part-time bookkeeper. It could be a full-time bookkeeper, depending on the size of your business. It could be a controller that's actually helping with payroll and other things. Or it might be a CFO if you're big enough that's doing pro formas and projections and looking at margins. The second person on the team is a tax strategist.
Yep.
Now, I want you to make sure they're not a historian, but a strategist. If they just tell you after the fact what you owe or just to defer taxes, that's a historian.
It's good clarification.
If they proactively help you navigate the taxes and how to maximize deductions, that's a strategist. The third is an attorney. So that attorney might be a corporate attorney for a small business or a tax attorney for a larger business, because now you want to choose the right types of corporations that minimize your tax with things like self-employment tax. Or in Sam's case, maybe choosing a different election on his corporation might change how that's taxed, and you might not have to go and spend this right now to save on tax. And the fourth one is people that have commercial property might want to get an engineer for something called cost segregation.
Yep.
The first bucket is the team, and it's what I call the 3 by 3 by 3 strategy, okay? Now, a tax team begins with record keeping. So you got to have some type of bookkeeper, controller, or CFO, because timely data is going to save you money. When you have that information, so you can make decisions along the way, that's going to be super useful. So the first one would be just some type of bookkeeping, right? The second one is a tax strategist. A tax strategist might be a CPA, but a CPA might not be a tax strategist. Some CPAs, their job is to file your taxes, not to talk to you about how to maximize tax deductions. And if you want to know whether they're a tax strategist or not, tax strategists don't use the word like, hey, my number one job is to keep you away from an audit. Hey, I'm really conservative. People that say that are letting you know you're overpaying on your taxes, and they've given the excuse up front so you won't be mad at them. Like, why be conservative if you're taking full advantage of the law within the law? Like, where it's not conservative, this would be a dumb idea, is not to report your income. That's what gets you into trouble in the US, not reporting your income. Another thing that gets you into trouble, if you take a deduction that's not allowed that was more than 20% of your overall tax deductions, there could be a 25% penalty. But there's a lot of people that are completely afraid of audits, but the IRS intends to audit you at least once during your lifetime. I look at an audit as market research for me. I personally do. And then for a lot of our clients, I look at it as like a 33% chance we're going to save more money, and almost a 0% chance they're going to owe more. So if you're a sole proprietor, you have a 400% higher chance of audit, so incorporating helps you out. If you're an LLC or an S Corp, you're less likely to get the best auditors. Those are usually reserved for C corporations. So just a few things to kind of note. But if you did get audited, if you're well organized, because you have good bookkeeping, and you got those documents, and that you treat them extraordinarily well, and not you, but your tax team, and you never go to your audit because you're not the CPA, let your tax team handle it, because if they ask you a question you don't know, that's a red flag. They ask your tax team, it's not a red flag. The tax person gets to say, you know, I'm gonna have to check with David on that, and I'll get back to you. And by the way, that tax person has a direct line to the IRS, and you don't. So you just don't have to stress and worry, and there's plenty of opportunity to get money back in an audit, because now you can get really aggressive when they're sitting across from you, and they'll either leave quickly or you save a little bit of money. The third piece is a tax attorney, or at minimum a corporate attorney. Like, this is where most of the value of saving tax comes from, and because we have a lot of people in here, I'll actually just throw in, if you're in real estate, you might want a cost segregation engineer if you own commercial property, because you can accelerate your depreciation, and they can do a study for that. So that might be one to the team. But, okay, so we've got the 3 people here. your bookkeeper, your tax strategist, your tax attorney, and then every 3 months, you do a phone call with them. That phone call could be as little as 20 minutes in length or as long as 60 minutes in length. Your job is to be an entrepreneur on that phone call. Realize you're not talking to the IRS, you're not taking any action from that call, so it's your time to brainstorm. I have my call coming up in June. The first question I'm going to ask is, I just bought a Can-Am, you know those twin turbo, like go-kart, souped up things? Can I write that off? Now they're gonna say no. Then I'm gonna say, but we just filmed it and it's gonna be at the beginning of every podcast. Every podcast guest gets to go for a ride. Like, I'm gonna get some percentage of that written off. It won't be completely zero. I know it's not 100%, but I always start with just brainstorming. Hey, I'm going to Italy, can I write off the trip? They go, no. I'm like, but I'm hosting a mastermind one of the days. This number of clients are coming to visit. We're gonna go to where my great-grandfather's from with the drone, and we're gonna get footage there. You know, we're gonna, like, by the end of the call, it was 55% of the trip I was able to write off. Because one, I had to do a corporate compliance meeting for every entity that I owned. So those mills, part of the travel, right? So like, that's your job, is just to ask questions. And if you say, can I write this off? And they say no, say in what case or what type of business could someone write this off? And that might give you some insight. Or you ask them questions like, what's the coolest tax strategy you've learned about or implemented since the last time we talked? Could that apply to me? Like, their job is more to navigate the tax code and stay within the law. My job is to be an entrepreneur and to think like a strategist. So I'm just asking them a boatload of questions. We're actually recording my calls now and giving them to the people that work with us so they can just hear exactly how I do it. It'll be entertaining, I will give you that. Like, I just ask the most ridiculous things on that, and then I go, no, I'm just kidding, we're not trying to write that off. But it's still fun to play with these guys. They don't always have the full sense of humor that they should. So, 3 people that's on your team, you meet every 3 months, and then every 3 years you get a different set of eyes and you go look back and see if you've missed something. So you can go back for, I mentioned R&D, so if you've done any software development, modified a CRM, done any technology that had to do with you used employees inside the United States, there's major credits from Section 199. Or domestic production, did you do research? Like now I'm doing research, right, with BYU University, which will just make even more people Google Garrett Gunderson LDS. That's the second most Googled thing. People want to know if I'm LDS. I look like Jesus, so that's confusing. Or at least the Utah version of Jesus, not the Middle East one. But ultimately, like, BYU is the one that stepped up. So, and yeah, I'm not Mormon, just so you don't have to Google it. I don't want that like becoming the #1 Google. So, as we have these meetings every 3 years, you can look back and amend the returns if something was missed. Domestic production is looking and finding out, did I do research and that research lead to a product that created income? I can take a certain percentage of net revenue in credits. Above and beyond the cost or the hard cost, this becomes incentives that you can go back. So that would be one way of looking back, or maybe just something was missed. We just went through looking at amending someone's returns that became our client recently. They were paying 3.2% tax on every dollar of income that they had that wasn't required to be paid on. So it wasn't that we were that genius, but that was hundreds of thousands of dollars from a mistake. By getting a different set of eyes, they're able to go back and amend returns. So meet every quarter, look back every 3 years. What I tell these people when they go back and look every 3 years, like every 3 years, I just say, I'll pay your fee. If you find something, I'll double it. And if you find something major, you'll either be added to the team or replace someone on the team. And by the way, that means you're gonna get a lot more business than just me because of the business we're in. So that's what I do on that side. Okay, so that's the team.
Then I had this idea. Why not bring my kids? I mean, they can handle a red-eye flight. I'm not torturing my team. I got my kids doing this. They can sleep so easily on flights. We can even bond. They can carry books. They can pass them out. Maybe even introduce me on stage. Plus, they could earn money that would be, get this, tax-free. Yep, up to $12,000 tax-free. Even better, I'm the one on the account since they're minors, right? So I'm not just handing them money that they can blow. I can now allocate those dollars to building their own cash flow banking system, which is a way to put the money in pre-tax, have it grow tax deferred, and there's ways to access that money tax-free, whether they go to college or not. So, I wouldn't have to pay the tax now or later. You could do this with a Roth IRA, but there are certain restrictions to that. But now the key to the strategy comes down to, first and foremost, integrity. You actually have to hire your kids to do work that you're paying them for in order to get this tax break. Let me break it down into 3 simple parts for you, and even give you some ideas of what you could hire them for. 1, if you stay under the limit, they don't even have to file a tax return. This is normally what happens. You get to deduct their wages, and it will lower your tax bracket. The question really becomes, though, well, what would you hire them for? I wish I would have thought of this when my kids were really young. I didn't know how to pay them at 2 years old, but later realized they could be paid for modeling. Now, not normal models for my business, right? So I get that's probably not worth $12,000, no matter how cute I think they are, but it can easily be worth $2,500. Put them up on a site, have pictures at the office. As they get older, then you can actually put them to work. That's what I did. I missed the opportunity to have them model, which is something that if you have young enough kids, you might be able to do. What I've had them do is MC events multiple times and even introduce me. I've had them go through online courses so they could start a business. I had a lot of clients on Amazon, selling things on Amazon. So I got a course when I spoke at one of these events, and I said, all right, let's have them work on this research, because one of my clients talks about retail arbitrage. I'm like, I wonder what that is. So it was about starting a business with my oldest son at that point. My youngest son, I started to write this book on money for kids. Well, I needed to have feedback and editing and stories. Does it make sense to someone that age? And he's actually really creative when it comes to writing. Those are just a few ideas. Now, I've seen other of my clients have their kids clean the office and wash company cars. That's actually how I started my first business, Garrett Gunderson's Car Care, when I was 15 years old. It was my dad being a coal miner. I started washing the surface mine vehicles with him and get paid for that. Or you might have them update a CRM or customer lists or different data entry, working in the computer, or giving me billings and accounts receivable, which I've seen happen with a lot of my doctor clients, or general errands that they're doing. And if they're under 16, these are ones that they can obviously do without having to drive. Or maybe they're even handing out flyers for something that's coming up, or updating social media accounts, or keeping you current on social media trends. I know if I want to know what's going on there, I turn to my 12 and 14-year-old. They know a lot more than I do.
And so obviously if you invest in things that are beneficial for the business, but they have to make economic and fundamental sense first, tax benefits second.
Okay.
If we go make a tax decision like, hey, I'm going to go spend this money. Like I met with someone on an immersion like a year and a half ago. I guess it's coming up on 2 years in this December. Crazy. And they bought a new Ferrari every year. Mm-hmm. I was like, you really into Ferrari? He's like, no, but I need to get a write-off. I'm like, well, this isn't the best way to get a write-off.
Yeah.
Because does it depreciate after you buy it? Are you buying it new? Are you getting a lot of use out of it? You're paying for insurance on it. Like maintenance on those types of cars is quite a bit. I said, would you do it if there wasn't a tax benefit? He said, probably not. And I said, okay, well, let's look at other strategies. What's funny about tax? Nothing. But we might as well figure it out so you can keep a lot more of the money you make without tipping this partner called the government. Click here to find out more.